Revenue recognition is a critical aspect of financial reporting, as it directly impacts how companies report their income. In the world of accounting, GAAP, Generally Accepted Accounting Principles, and IFRS, International Financial Reporting Standards, are two of the most widely used frameworks for preparing financial statements. While both aim to provide clear and accurate financial data, there are notable differences in how they approach revenue recognition. Understanding these differences is crucial for multinational companies, investors, and accountants who work in environments that require compliance with either or both of these standards. This video outlines the top 10 differences between GAAP and IFRS in the area of revenue recognition. 1. Revenue recognition timing. Under GAAP, revenue is recognized when it is earned and realizable, which often occurs when the product is delivered or the service is performed. In contrast, IFRS tends to focus on when risks and rewards associated with ownership of the good or service are transferred. This can sometimes lead to slight differences in the timing of revenue recognition, as IFRS emphasizes the transfer of control rather than just the completion of performance. 2. Contract modifications. The way contract modifications are treated differs under the two standards. Under GAAP, if a contract is modified and the modification creates new obligations, the contract is considered a new contract. This means that revenue may be recognized differently for the original contract versus the modification. Under IFRS, contract modifications are generally treated as amendments to the existing contract, and revenue may be adjusted accordingly. 3. Multiple element arrangements. Under GAAP, multiple element arrangements, i.e., contracts where goods and services are provided together, require that each element be accounted for separately and that revenue is allocated to each component based on its fair value. IFRS, however, generally allows for more flexibility in allocating revenue among different elements of the arrangement. This can result in different revenue recognition timelines between the two standards when dealing with bundled contracts. 4. Collectibility criteria. In terms of collectibility, GAAP has more stringent criteria for recognizing revenue. Revenue cannot be recognized until there is a reasonable assurance that the amount will be collectible. In comparison, IFRS has slightly less strict criteria, recognizing revenue when it is probable that the economic benefits will flow to the entity, even if collectibility is not fully certain. 5. Principal versus agent considerations. The distinction between whether an entity acts as a principal or an agent in a transaction is crucial for revenue recognition. GAAP and IFRS both require careful analysis of whether an entity controls the goods or services before they are transferred to the customer. However, IFRS has more detailed guidance, especially in determining whether a company is acting as a principal or agent in complex transactions like online sales or commission-based models. Under GAAP, this distinction can be a bit more flexible, depending on how the arrangement is structured. 6. Timing of revenue recognition for construction contracts. In the case of long-term contracts, such as construction contracts, GAAP and IFRS treat revenue recognition differently. GAAP often uses the percentage of completion method, where revenue is recognized over the duration of the project based on costs incurred. IFRS also allows the percentage of completion method but has more flexible rules regarding when the revenue should be recognized, such as when the outcome of the contract can be reliably estimated. The timing and degree of completion can lead to different reporting outcomes under the two standards. 7. Revenue from software and licensing. The treatment of revenue from software and licensing arrangements is another area where GAAP and IFRS diverge. Under GAAP, revenue from software is typically recognized when the software is delivered, and the customer has access to it. In contrast, IFRS may require recognizing the revenue over time, particularly if the software involves ongoing support or services. This difference can lead to significant timing differences in how software revenue is reported. 8. Discounts, rebates, and returns. Both GAAP and IFRS require that companies consider discounts, rebates, and returns when recognizing revenue, but the approaches can differ. Under GAAP, companies must estimate the amount of revenue that will not be collected due to discounts or returns and reduce revenue accordingly. IFRS requires a similar approach but tends to emphasize the use of expected value or most likely amount methods to estimate the impact of returns or discounts. This subtle difference can affect the revenue amounts reported by companies. 9. Variable consideration. In both GAAP and IFRS, variable consideration, e.g., discounts, bonuses, performance-based payments, is a significant factor in revenue recognition. However, the two standards approach the estimation of variable consideration differently. GAAP requires a probabilistic approach to estimate variable consideration and recognizes it when it is highly probable that a significant reversal in the amount of revenue will not occur. IFRS, on the other hand, allows for the use of either a probabilistic or expected value approach and tends to be more flexible in how variable consideration is accounted for. 10. Disclosures and presentation. Finally, GAAP and IFRS differ in their requirements for disclosure and presentation of revenue recognition practices. GAAP requires more detailed disclosures in the form of footnotes, especially when multiple revenue streams are involved. IFRS is more focused on providing qualitative disclosures, such as how revenue recognition policies align with the transfer of control, and less focused on quantitative disclosure requirements. This difference in presentation may affect how companies communicate their revenue recognition policies to stakeholders. In conclusion, GAAP and IFRS both provide frameworks for recognizing revenue, but they diverge in several key areas. The differences in timing, methodology, and criteria can lead to variations in how revenue is recognized, reported, and disclosed. While these differences are important for accountants and auditors to understand, they also highlight the need for multinational companies to ensure compliance with the relevant accounting standards in the jurisdictions where they operate. For businesses that operate internationally or are planning to expand globally, understanding these differences is crucial in preparing financial statements that are both accurate and compliant with local regulations. As the world continues to globalize, it's possible that more harmonization between GAAP and IFRS will occur. But for now, these distinctions remain significant in the accounting and financial reporting landscapes.